US job growth slowed in January, but a 4% unemployment rate still makes a spring cut from the Fed look unlikely. US non-farm payrolls added 143,000 jobs in January. That's below forecasts and sharply down on December, which was revised up to 307,000. The unemployment rate is still at just 4% though, even after it was adjusted for population. Well, Gregory Daco is chief economist at Parthenon. Gregory, what do you make of this number? I know you were forecasting more.
Yeah, so this is an interesting number because it shows a few things in terms of the underlying trends for the US labor market. It shows that as we started the year, even though we carried solid momentum in November and December, we saw a little bit of a softening in the pace of job growth. We're still in what I describe as a robust labor market, but it seems to be largely frozen. We're seeing that the job growth concentration is increasing amongst a few sectors, and we're seeing some pullback in hours worked by private sector employees. So those are signs that there is still a little bit of fragility in the US labor market.
Where do you expect it to go from here then?
Well, I think that's the key question that many will be asking, from business leaders to policymakers, as to what the next step will be in this labor market. The fact that it's frozen indicates to you that we are in an environment where there is a delicate balance between labor supply and labor demand. As we navigate through the year, I think we're going to be in an environment where we see more moderate job growth, around 100,000 to 150,000, in line with what we saw in January, but still a low unemployment rate because employers are reticent to let go of their prized talent pool that they struggled so hard to hire and now train in order to facilitate stronger productivity growth and offset some of the wage pressures.
This is the last data, of course, gathered partly under the Biden administration. President Trump has inherited, as you say, a robust labour market. Is he going to keep it that way, or could tariff policies lead to a wider slowdown?
Well, that's the key question in terms of the policy uncertainty. We have an economy that very much looks like a Goldilocks economy as we start 2025. We've seen over the past 2 years that the economy has been growing at a 3% pace. The unemployment rate is at 4%, which is a historical low, and we're seeing inflation converge towards the Fed's 2% target. All of those are strong fundamentals to start 2025. And if you add to that mix a strong productivity growth environment, you have all the right ingredients for sustainable growth. The key question is whether tax policy, trade policy, immigration policy, regulation are going to affect the economic trajectory of the US economy. We think they will. We think there will be increasing inflationary pressures and perhaps a bit of a drag on growth, especially if tariffs are put in place.
The story of the last 4 years or so was one of tight labour markets pushing wages up in the US. Could we see that come back, do you think?
I think that's certainly a risk that we start to see renewed inflationary pressures coming from the labor market. But in the current environment, we have the luxury of strong productivity. And I say the luxury with intent, because in an environment where you have strong productivity growth, you can afford higher wage pressures as an employer because your unit labor costs are not rising proportionally. That allows consumers to benefit from stronger income growth and in turn be able to spend. So right now, we're not in an environment where the labor market is instilling any inflationary pressures on the economy, but there's certainly a risk that if we start to see more protectionist measures being put in place, more immigration restrictions that reduce labor supply, that we could start to see more of these inflationary pressures coming from the labor market.
For you, Gregory, does this weaker number create a case for an earlier rate cut, or are you still not expecting it before the summer?
No, I think generally speaking, we're going to see Fed policymakers take all of the data in this latest report, including the revisions over the past few years, to essentially adopt a wait and see approach. They will likely want to see more data, more potential evidence of a softening in the labor market to reconsider easing monetary policy going forward. So I think they're going to be on hold until June. We've actually revised our forecast, whereas previously we anticipated 3 rate cuts over the course of 2025. We now only expect 2 rate cuts in June and December of this year.
That was Gregory Daco of Parthenon. And don't forget, you can watch more videos on Reuters.com.